Kristina Hooper is the Chief Global Market Strategist at Invesco, and she joins me now from Greenwich, Connecticut. Great to see you.
Great to see you, Allison.
Well, I am hearing today, especially when we saw the Dow fall more than 1,000 points, hearing today this is capitulation day. But is this a market that you're seeing that's oversold or not sold enough?
I think it's not sold enough. I think we take a step back and look at where we are. Early January, the release of the minutes from December's FOMC meeting was the unofficial start of tightening season for the Fed. And that really triggered significant volatility and started the slide downward for stocks. They are going through a re-rating process. Richard talked about that. There's an evaluation of stocks, and they're moving lower given rising rates and the expectations about the Fed. But I will give this caveat. We're not exactly sure what the Fed is going to do. At this point, people are letting their imaginations run wild. And quite often, reality is a lot better than what our imaginations can conjure up.
Yeah, some saying this could be just an overreaction, but there is also the thinking that the Fed, already has made a big mistake by not being more aggressive early on about inflation.
Well, it was very difficult for the Fed to know how to act because it has dual mandates. Some central banks don't have dual mandates. And so the Fed has been juggling that employment mandate along with that controlling prices mandate. But now that it feels as though it has met the mandate on full employment, now we can focus more on inflation. But I do believe that we're going to see continued volatility. We're going to continue to see some downward days until we actually get more clarity from the Fed, and in particular, until we see liftoff for rate hikes.
I went back in the stock market almanac, actually, and I know that in your notes that we got before we interviewed you, you said to not fear higher rates, but there is some history here that each of the 10 recessions since 1955, they were preceded by a significant rise in benchmark interest rates, little nudges of the monetary needle intended to produce a moderation of inflation without pushing the economy off a cliff. The problem is we see a lag of how policy, how the impact of it, there's a lag of 9 to 12 months of the impact of that policy. And it makes it difficult to know if rates have risen too far until it's too late. Is this the market showing that it's concerned that the Fed may be too aggressive and may not realize it until it's too late?
Oh, absolutely. The market is fearing an aggressive Fed, and it really has let its imagination run wild in terms of what it thinks the Fed can do this year. But I have to say that we actually can take comfort in knowing that the Fed anticipates employing three tools this year, right? Not only is it tapering its balance sheet, but it also expects to raise rates and actually shrink its balance sheet. So having three tools takes pressure off the primary tool of raising rates. So I do take hope from that, but you're absolutely right. This is a delicate balancing act, and the Fed could easily commit a policy error, which is why we have such market jitters right now.
What are the other speed bumps you see going forward?
Well, clearly, Omicron is continuing to be a problem. I think it's going to be a short-term problem, but it is certainly impacting the services side of economies like the United States, like Japan, and really any country it runs through. But also, it is likely to exacerbate inflation with the supply chain disruptions. Also exacerbating inflation, unfortunately, is the potential for a Russian invasion of Ukraine. That could drive up oil prices and add to inflationary pressures.
Okay, Kristina Hooper, the Chief Global Market Strategist at Invesco. Great to get your analysis today. Thanks.
Thank you.